Hello everyone, welcome back. I got some really good ones for you this evening on this Sunday, August 27th, 2023. A lot's been going on with the markets, and that's what we're going to be focusing on for this evening's video, kind of unpacking how the Jackson Hole Symposium went, the speech with Jerome Powell on Friday, kind of market expectations going in, how the markets reacted, and where I think we're going with all this. So welcome, glad you made it, glad we could hang out together. I'm doing well, I hope the same for you, and let's dive right into it, shall we? So going into the Jackson Hole Symposium speech, which occurred on Friday, that whole week prior, last week, Monday, Tuesday, Wednesday, and even the week before that, we've seen a little bit of pressure on markets, rising interest rates, rising relative strength of the dollar, rising 10-year yield. What's going on? Well, I believe the markets had been pricing in the coming Jackson Hole Symposium. I think markets kind of figured if the economy was doing well and perhaps not cooling as quickly as the Fed would like, we would get a pretty hawkish speech at the Jackson Hole Symposium. And it looks like we did. I listened to Jerome Powell's 12 to 15 minute or so speech, came out pretty hawkish. Then what I did was I took the script of the speech and I plugged it into ChatGPT. I said, is this hawkish or dovish? It said hawkish. I said on a scale of 1 to 10, 10 being really hawkish, 1 being quite neutral. How hawkish, it gave me a 7. It's really fun to use ChatGPT as your little personal assistant. So anytime a Fed governor or president or chairman or woman gives one of these speeches and you're thinking, I'd like a second opinion, just go ahead and copy the script, plug it into ChatGPT. Maybe say, explain this to me like I'm in 9th grade or on a scale of 1 to 10, or it can really help you and break things down. And it's not that we need these Fed speeches simplified because we're dumb. It's that they intentionally use really confusing wording. That's not by accident. Every one of those words in a Fed speech is very meticulously selected to play mind games with the market listening, to play 4D chess with people, to kind of manage expectations. So I never think for a second that Fed Chair Powell is doing anything by accident to include putting you to sleep. If he's putting you to sleep, well, he's probably engineering a heist of everything you know through interest rate cuts or something. So, every one of those words, guys, is very, very carefully selected by the Beast system to include the Q&As. Okay, even the questions are pre-selected, the answers are pre-written. Powell is reading from a script at every one of these speeches, and if he were to go off script, that could really mess the game up and ruin him. So just know that anytime the Fed is trying to put you to sleep with one of their typical speeches, they're playing 4D chess with you. If they sound confusing, they're doing it on purpose, etc. So I listened to the speech. I got a hawkish vibe from it. Powell focusing more on getting inflation under control, trying to get back to their magical 2% number, and not really a whole lot of talk out of concerns for the banking sector, concerns for rising rates and yields, concerns for what's going on in China with the Evergrande and the Chinese real estate debacle. So not really a whole lot of dovish talk, not really a whole lot of talk about wanting to be there and support markets. Really, it was quite hawkish. It was essentially more the same that we've been getting from the Fed throughout the year. But maybe the only difference being Powell's ready to pivot, I guess, if the lagging effects of all these interest rate hikes really start to cool things down too quickly. Powell says we want to be able to turn quickly, pivot. We want to be agile in our policy. We want to take these interest rate hikes or cuts, or holding steady on a case-by-case, meeting-by-meeting basis. So that's kind of what you got out of Powell. ChatGPT called it hawkish. The market figured it would be hawkish, so it priced that in the weeks prior. That's why on Friday, as soon as Powell gave his hawkish speech, I believe markets inflated, because the market had already known Powell's speech was going to err on the more hawkish side. So he had a lot of selling going into the speech. And then it's kind of a sell the rumor, buy the fact. So sell the market going into the speech. And then once you get what you were expecting, cover that short position, which is buying, So I'll probably do an entire video on shorting and covering, to kind of help explain that for you guys. But just know that when You short a stock and then you go to cover it. When you cover, you're buying, okay? So if you have a bunch of traders betting against a stock and then they all decide, I'm done betting against this stock, well, that is buying, and that makes the price go up, and then buyers see the price going up and then they jump in. That's also what's called a short squeeze. When a bunch of shorts cover, that sends the price higher, than the long show up to bid it up further, and then anyone left short just gets completely decimated. Anyway, I'll probably give you guys a whole video on shorting and covering, but just know that the market, was one step ahead of Powell's speech, in my opinion. Kind of like how the market is often one step ahead of earnings on a stock, or one step ahead of a bit of economic data. I'll give you an example. And this happens all the time. This happens more often than not. Let's say stock XYZ next week is, this is just hypothetical, is going to be reporting earnings. And let's say we think earnings are going to come about 10% above analyst expectations. Well, I might tell my homies on Wall Street, yo, this stock is going to perform a little bit better with their earnings than the street is anticipating. We need to buy this thing. So we all start buying the stock before the earnings. And then when the earnings roll around, even if you get 10% higher than what analysts were expecting, the stock might actually sell off that day because everyone already knew about it. They already bought, so when they got the news they were waiting for, there's no reason to stay. They sold. That's the good old buy the rumor, sell the fact. You might be getting a little bit of that with NVIDIA. So NVIDIA just reported blowout earnings, right? And the stock actually backed off a little bit. And that's because the street probably knew months ago that NVIDIA's earnings were going to be blowout. They priced that into the market with NVIDIA's massive move up to about 500 a share. And once, these amazing earnings are baked in, once you actually read the headline and get what you were looking for, sell, so book your profit, and then the stock comes down. And to an untrained eye, they might say, why did we get such amazing earnings and the stock is falling? Buy the rumor, sell the fact. The market is usually one step ahead of the headlines. So it's kind of what you got going on there. You saw it a little bit with NVIDIA. You saw it a little bit with the Federal Reserve as we shorted the market going into the Jackson Hole Symposium speech on Friday, got the speech, covered the short positions. That is buying. Market kind of takes breathes a sigh of relief. As we're looking forward to the coming Fed meetings, you'll see that we'll have another FOMC meeting with the Fed on September 19th through 20th. There's about a 20% chance right now in the markets that we'll see an interest rate hike of 25 basis points, or 0.25% to the Fed funds rate on September 20th. So about a 20% chance of a rate hike on September 20th, but over a 50% chance of a rate hike in November. So it looks like we're going to have 1 to 2 maybe more interest rate hikes. And this is just to finish out the interest rate hike cycle, hold rates as high as, is steady and as high as the Fed can for as long as they can, until ultimately something goes wrong, which I'm here to tell you something's probably gonna go wrong. That's just life in general. That's not even really my hazy crystal ball saying that. That's just as soon as the Fed gets themselves into a position where they're really comfortable with policy and things are stable and they like where we're at, well, something happens, okay? Russia invades Ukraine, or China invades Taiwan. Not that that's happened yet, but things happen, right? The banking system might start to implode. We might see more Silicon Valley Bank type implosions, and then the Fed is going to have to pivot, and that's to interest rate cuts, So we're really finishing up the interest rate hiking cycle, and I think the market's getting giddy about that. Man, this interest rate hike cycle is pretty gnarly. The Fed, for the last year and a half, 2 years or so, has been, aggressively raising interest rates. Not that 0.25% or 0.5% at a time is aggressive. I really would have liked to see some 1% hikes of the Fed funds, Paul Volcker style. Go ahead and look up Paul Volcker. He was a Fed chair in the 70s that was so hell-bent on getting inflation under control. He rose mortgage rates to like 21%. He rose the Fed funds rate to like 18 or 19%, putting mortgages at 21% in 1981. That's an aggressive and hawkish Fed. In the world we got now, we got doves like Janet Yellen, and then baby doves like Jerome Powell. Or we have like doves in disguise. Jerome Powell kind of seems hawkish sometimes, but he really is a dove in disguise. something along the lines of, maybe instead of printing $20 trillion next year, I'll print only 10. It's like, seems hawkish given the environment we're in, but he's a dove, you know what I mean? So that's really what you got going on with markets. A little bit of buy the rumor, sell the fact going on with the Jackson Hole Symposium. Same thing for NVIDIA. 20% chance as of right now for an interest rate hike of 25 basis points on September 20th. And then looking at a pretty decent above 50% chance of an interest rate hike come November. But then, guys, I think we're done. We're done with interest rate hikes. The Fed's going to hold pat. Something's going to go wrong. Inevitably, I couldn't tell you what it is, but something more than likely is going to go wrong. Always, never fails. And then the Fed's going to have to make some difficult decisions. Do they want to hold rates steady in the face of that, or do they want to start actually cutting interest rates, Or they could hold the rate steady, and this is just me thinking out loud, they could hold the rate steady and then just print a ton more money, you know what I mean? Those aren't mutually exclusive. Like, I'm sure the Fed could find a way to hold rates where they're at and then still find a way to support the market, accommodate the market, stuff some fake money into the market somehow while simultaneously keeping rates high. But that's just me kind of thinking out loud. The Fed won't dilly-dally when it comes to a crisis. They will, in my opinion, move to cut. But here's the deal, guys. When they cut interest rates, the next time the Fed cuts interest rates, which could be as early as 2024, it should be bullish for markets. Kind of like what we saw in 2020 when the pandemic hit in April 2020, worst recession ever. But the market's hyperinflated because they cut interest rates from 1.25%, which was already way too low, down to 0, added 40% to the money supply, and hyperinflated the markets so that the elites could keep eating and the working middle class could get flushed. So I don't think the Fed's going to wait around as soon as something goes wrong, either maybe around Christmas time or next year sometime. Fed's going to be cutting, and that should be pushing markets higher. Because what'll happen is something goes wrong, some sort of deflationary event that we weren't really ready for. The Fed's going to start to buy a bunch of 10-year Treasury, buy a bunch of bonds. They're going to drive bond yields down. They're going to make the bond bubble even fatter, the dollar even weaker. And then as the bond bubble gets fatter, these other risk markets out to the end of the risk curve, like real estate, stock market, beanie babies, precious metals, crypto, energy, and so on, if they see the bond bubble inflating, they're going to inflate. It was a 10-year yield in 2020 of 0.65% that put Bitcoin at 60,000. So take a look at the 10-year yield right now. You'll see it's probably hanging out around 4.2% right now. If that 10-year yield were to go down again to like 0.6%, all the way down to like, call it 1% even, that would send Bitcoin, in my opinion, to 100,000. On the flip side of that, if that 10-year yield keeps rising from here, from 4.2 up to, call it 5.5%, well, that could put Bitcoin back down to 10,000. So kind of gives you an idea how ultimately the bond market decides the fate of the rest of these other markets. And by watching the bond market, even if you're not trading it, you can get a really good idea of the mechanisms in the market that are kind of sending your favorite asset class, up or down. So for now, the Fed's going to hold interest rates steady, then come probably November, one more hike, and then they're going to be done. And the market really likes the sound of that because they don't want to see yields, rates, and the dollar move any higher from here. And if they don't, then we're just kind of waiting for something to go wrong. And then the Fed's going to drop interest rates, bond yields, the dollar, and they're going to just continue to inflate. That's just kind of what you got going on. I'm not saying good or bad. I'm just saying that's kind of what we're dealing with. So yeah, Powell kind of threaded the needle on Friday. He did come out a little bit more on the hawkish side, but I think he felt like he needed to. Look, if they wanted to solve the inflation problem that Powell is telling you he's committed to solving, they could do it a month ago. They could do it a year and a half ago. All they would need to do is take the federal funds rate above the inflation rate and raise capital reserve requirements for banks. So if your inflation rate is 5% next year, which I think is, probably somewhere in there, well, you'd need to raise interest rates to 6%. because if you're getting paid 6% on your deposit, inflation's only 5%, you're actually net, you're still making 1%. So it's a positive yield for the dollar. And if the dollar has a positive value, it pushes risk assets and inflation down. On the flip side of that, if the Fed does what they've been doing and continues to do, which is keep your interest rate below the inflation rate, well, not only is cash worthless, it's worth less than nothing, because I'm paying you, call it 1% on your deposits. I'm paying you a 1% interest rate, and then I'm inflating away your currency at 5% a year. So I'm stealing net 4% from you. And that's how the bank sticks its long hand into your account, okay? They pay you, put $1,000 into a checking account. They're going to pay you like $10 in interest, and then the $1,000 after 1 year is going to buy about $950 worth of stuff. So net, they stole $40 from you, and thanks for your contribution. So that's kind of what you got going on. Fed's trying to keep interest rates moving up to kind of get inflation down, but they don't want to move too quick on solving the inflation problem, because it would really destroy their markets. And the Fed, as we've discussed, it totally going to protect the markets, protect the beast system, protect their benchmarks. So that's really all you got for right now in markets. I hope this video finds you doing well. Just a quick video, but we will reconvene as things progress. If you found any of this useful, if you could hit a like, subscribe, or comment, share, whatever, that would be great. And I hope you guys are doing well. And we're just going to keep going, all right? Thanks for watching. Till next time.